Most people think markets are random, but there is an entire playbook behind every move. And if you don't understand this playbook, you'll always be reacting to the market instead of thinking ahead. You'll be the last to know why prices moved, the last to understand why your trade went wrong, and the last to profit. That ends today. Simply, at its core, the market is driven by just three things. Let's start with Pillar 1, demand and supply. This is the foundation on which every single market runs. Buyers push the price up, sellers push the price down. That's it. That's the whole game. Let's say we have a hypothetical market. 50% buyers, 50% sellers. Stock is sitting at $100. Now something shifts. Buyers jump to 70% of the market. Sellers drop to 30%. Demand is up, supply is tight, and that stock climbs to $120. Simple. One more example. Stock A is trading at $10, but the market believes its fair value is $7. Nobody wants to overpay, so buyers step back, sellers dominate, and the price gets dragged down to $7. The market always finds its level. And what causes that shift in demand? Something like a company beating its earnings, better than expected results. Confidence goes up, demand spikes, price follows. That's the cycle. But demand and supply alone don't move markets. There's something else, something most people completely overlook. Pillar 2, information flow. Markets react to new information constantly, and when expectations change, money moves. Earnings reports, interest rate decisions, inflation numbers, geopolitical events. All of this changes how investors think and where they put their money. Take Trump as a real-world example. He tweets, he announces tariffs on China. Investors don't like uncertainty. Capital starts pulling out. Sentiment turns negative. And just like that, markets go red. Information is power. And in markets, whoever acts on it first wins. Third, and this is the most important pillar, big money. Institutional investors, hedge funds, mutual funds, banks, they control the majority of capital in the market. When they buy or sell, prices don't just move, they shift. A retail trader might be working with $10,000, an institution, $50 billion, with leverage on top of that. That kind of buying power lets them move markets in their favor. They set the direction, everyone else follows, and they don't just throw money around, they do careful, deep due diligence before making a single move. Let's look at how a large institutional order actually changes price movement. See that order right there? That's a firm placing a massive buy position. Watch what happens next. Price moves up, because that's what a large buy order does. They use sophisticated analysis, data models, and market intelligence to decide exactly when and where to enter. So stop assuming markets are random. Stop thinking it's luck. Every candle, every move, every spike has a reason behind it. There is always a playbook behind everything, whether it's demand and supply driving the price, whether it's new information shifting expectations, or whether it's some big bank hunting your stop loss. The market isn't chaos, it's chess. And once you understand who the players are and why they move, you stop being the pawn. We break all of this down in a way that's simple, clear, and actually useful, so that being a market analyst doesn't feel so out of reach. Thanks for watching. If this helped you see the market differently, like, share, and subscribe.